Good afternoon and good morning to our international investors. Welcome to our second Investor Day, and as you can see, it's our PGM Investor Day. First of all, like all our presentations, please take note of the safe harbor statement. There are forward-looking statements, and I'm not going to ask you to read this like Richard did last time. All right, today I will again be assisted by a number of executives and senior managers of our organization. And as you know, I rate the importance of people, and specifically our people, very, very highly. And today you will again get significant exposure to both the competence and the depth of management within our organization. I'm pleased to kickstart the session with a brief introduction on our PGM journey. So let's have a look at that on the next slide. So just a bit of a refresh. To me, it's always important to remember where you've come from. And in 2014, we announced our intention to enter the PGM business based on the fact that our core competency at that time being medium and deep level underground mining and of course rock breaking was very similar in the PGM business. Of course, you cannot move into another commodity unless you fully understand the fundamentals related to the supply and demand of that particular commodity. So we conducted a very thorough and detailed analysis of the PGM market and of course the fundamentals that underpin the PGMs, which led us to developing a leading PGM business at a low point in the cycle. And that was not the only thing. I think we, being new entrants to the market, looked at things very differently, and we very specifically, for a period, have built up a large exposure to palladium and rhodium. That was not by mistake. That was based on some of the fundamentals that we understood at that time. And the net result is that we have built a leading global, and I want to emphasize the word global, PGM mining and recycling position. And we established that between 2016 and 2019. And of course, that was very swift and decisive action. And we always represent our strategic thinking in sigmoid curves. And you can see how we built off our gold base, which we had discussed at the last Investor Day. And you can see how we first acquired Aquarius Rustenburg. And in fact, Lonmin was meant to be the third acquisition, and it moved out to the fourth because we recognized the changing palladium market dynamics, and we also wanted to become global. That's a critical point. We're not just based in Southern Africa. We're not just based in Russia. We are a global PGM company, and we acquired Stillwater as our third step, which also gave us the very significant exposure to recycling. So it was rapid, well-timed, and obviously external and acquisitive growth. If you look at the timing of these acquisitions, and I also at the same time want to cover how they were financed, because we tend to forget. If you look at these graphs, and we used to use them often in our results updates, but as I said on the previous slide, Aquarius and Rustenburg transactions were announced within 6 weeks of each other. Aquarius was a very vanilla transaction. It was designed to give us the basis of a PGM management team, and it did that very well. The second transaction, being Rustenburg, was very specifically targeted to be done based on the synergies of these two assets. And of course, that was one way of reducing the risk. And let's not forget about the synergies between the assets that we bought. It was well considered and part of the rationale and reducing the cost base. We then acquired Stillwater. As I said, that was actually going to be the last transaction, but palladium we recognized was going to increase in price substantially. We moved that forward. We also realized that Lonmin was going to get cheaper. There was no appetite to buy PGM assets at this point in the cycle. And that is all now history. If you look, it was a total investment of 44 billion Rand or $3.3 billion. And that amount of investment was covered by our 2020 adjusted EBITDA. 1 year of adjusted EBITDA has paid for all these transactions. I think that's unsurpassed in any recent or any exposure I've had to the mining industry. I cannot remember such a successful M&A strategy. So very important, as I said, that these transactions and acquisitions were all identified and done in a very strategic way. As I said, Rustenburg and Aquarius were done to realize synergies. Lonmin was done at a low point in its history, and again is on the boundary of Rustenburg, and you will get more of this today from other presenters. But what that's allowed us to do is build up a PGM business, okay, which is large, material, but actually sits on the right side of the cost curve. And as you can see, many of our operations are moving into the lower quartile. The Stillwater operations, once the capex is completed, once we've had the ramp up, will move definitely into the lower quartile. But these acquisitions, which I think are often perceived as non-core assets to other companies and second-rate PGM assets, are clearly not. They're material in size, they are low cost, and they are long life. And that is a key message that I hope you see and understand and buy into today. As I said, the acquisition strategy was unparalleled in terms of value creation with short paybacks. And many of you will sit there and say, but you were lucky, you had the wind in your sails from the increase in commodity prices. Remember what I said right at the beginning. We actually took a very conscious decision based on the research that we had done to move into this market in a very aggressive way, so that we could capture what we could see as looming deficits. I'm not going to go through this table in detail, but if you follow it line by line and really just go to the last column, payback on investment, you can see Aquarius has done it 4.3 times in 5 years. Rustenburg 3.8 times in 4.5 years. Stillwater, because of the heavy capital expenditure, 0.7 times if you exclude the stream, 0.8 times including the stream in 4 years, so it's nearly paid for itself. And Lonmin amazingly has paid for it 6 times in the 2 years that we've owned it. The payback on the total investment is just over 2 times during this period. So again, let me recap what made this successful. It was a rapid delivery and execution of a clearly defined strategy. This was not speculating. This was well designed and carefully considered. Each transaction was carefully considered, and the risks related to each one of these steps had to be explained and covered with our board. We used quite dynamic financing and disciplined financing approaches to ensure that both the acquisitions were successful and it created value. You would remember that Rustenburg was based on a a structure where we paid for the assets out of future profits. You would remember a substantial part of Stillwater was paid back through a stream, and we are very, very happy with those structures that we put in place. We have proven through the acquisition sequence that we can integrate, and today we can certainly engage with just about any company and talk about a track record of proven integration. The move down the cost curves, we've shown that there's been significant cost synergies which were identified, and many of you will know that we far exceeded our original intentions. This was a very agile and decisive approach, and that approach is a competitive advantage. And I want to go to the next slide and just also just cover off on what is the relevance of that statement. So although today we're not going to talk about a green metal strategy or go into too much detail, but it's a clear evolution of exactly what I've just presented. It's a natural evolution of our value creation strategy. And again, I want to say, just like we did in PGMs, it's been, before we made our first move, it's been in planning for at least 2 years. That strategic intention was announced more than 2 years ago. It started with the acquisition of SFA Oxford in Q1 2020 when it was closed. And remember, we'd already done some of our own work, and that acquisition was really based on getting assistance and capacity to determine the most likely battery chemistries, and that we've done. We have confidence in our selection, and you've now seen it starting to play out. We're expanding our exposure to green metals through the battery metals as a start, and of course, I have mentioned the latent uranium potential that we discussed in the first Investor Day. We are also expanding and diversifying our existing recycling and tailings retreatment business. Today of relevance, there will be a discussion on recycling, and I remember there were some questions at the previous Investor Day on recycling, and we can certainly pick that up with today's session. We have made 3 battery metals related acquisitions in 2021. The very strategic acquisition of Keliber in Finland, the very strategic acquisition of a nickel refinery in France, and then more recently the joint venture with Ioneer on the Rhyolite Ridge project. And we will, in the not too distant future, as we add on a few more of our intended acquisitions, we will have a very specific focus on an investor battery day, perhaps even at the next announcement. So again, nothing different to what we did in PGMs, and I think the track record is established. We will be very disciplined in moving forward in this area, but I have the same good feeling about our entry into battery metals and building a green metals portfolio that I had when we made the entry into PGMs. So strategy is a consequence of conscious planning and positioning. Thank you. With that, I'm going to hand over to Richard Stewart, who will take us into the PGM market outlook. Thank you, Richard.
Thank you very much, Neil, and good afternoon to all our listeners, and good morning to any of those who might be abroad. I think really looking forward today to sharing with you what I certainly believe is a world-class PGM business that we have built over the last few years. And as we know, it all starts with the market outlook. Thank you. Our presentation does have several forward-looking statements, so I would urge you all to consider the safe harbor statement at your leisure. I guess just to kick off, when I reflect on when we got into the PGM industry, we were always asked why we were getting into it, and there were three fundamental answers to that, which we'll address all of today in one form or another. The first answer was that we had studied extensively the PGM market, and we're firmly convinced of the fundamentals of this market, not only for the immediate few years ahead, but in the longer term. And that is certainly what we look forward to sharing with you in this initial presentation. When we consider the PGM market, and I think we've said it on many occasions, PGMs are unique in so many ways. In this particular instance, and as it relates to markets, PGMs are by far the most precious of the precious metals. It's a very small market. In total, primary PGM production is less than 15 million ounces a year. When we compare that to the next most precious metal of gold, primary gold production is about 109 million ounces a year. And if you compare that to silver's over 900 million ounces of primary production a year. So PGMs really are a small market, but what makes them even more unique is it's underpinned by industrial uses. These are such special, such unique metals that play such a critical role in the world that we live in today, that it's a small market driven by industrial uses. And those two facts is what really drove the way we wanted to position ourselves in the markets and in the supply chain. In particular, our approach to our metals is not about just being a supplier and trying to trade our metals for a small premium of a couple of dollars here and there. It's really about embedding ourselves into the supply chain, working closely with our customers to help them manage or solve their solutions, but also about managing the overall balance between such rare metals, and not only the balance of total supply, but also the balance of the basket, as we've discussed on so many occasions. What this has meant from our side is that we've developed an extensive customer network and base we work with. It's a global network, it's a global customer base, and across as many different industries. We deal with OEMs, car OEMs, we deal with the auto fabricators and manufacturers, we deal with electronics and fuel cell companies, and this will continue to grow. I think, as we've also seen, more recently, we've recognized that part of solving our customers' solutions is also looking at battery metals, and that too is a market that we've studied extensively and drives some of our thinking around the PGM markets as well. How all of this thinking translates into our marketing and sales strategy is that we have really focused on longer term contracts. Most of our sales is done with our customers on a long-term basis, and that again is done specifically so that we can jointly manage a responsible supply. We do short-term spot sales as well on some of our metal, and that is critical both to provide us with a level of operational flexibility, but also so that we can keep our finger on the pulse of what is going on in the short-term tactical markets. But really what these long-term contractual relationships have done, and the value it brings to us, is that we do work closely understanding from our customers what is driving their long-term trends, their long-term strategies, and where demand is likely to go in terms of the strategies they are working on to deliver to what their customer bases ultimately require. Of course, we are sitting on the supply side of that curve. Supply is something we understand well. We understand the barriers of entry to this market. We also understand the barriers of exit to this market and what it takes to bring a new project online. So I dare say, when we look at our markets, we look at the fundamentals. A year ago, we were asked, how did we see COVID impacting on PGM markets? And the conclusion we came to was that we saw some extreme risk for volatility in the short term. That outlook was driven by the fact that we saw differentials in the way supply was coming back online due to COVID lockdowns. We also saw differentials across the globe in terms of how demand was reestablishing itself in different regions. And our concern at the time was that if you had a mismatch between supply coming online and demand coming online, that could lead to extreme volatility in the market. And I dare say that that has been even more extreme than what we thought could be the case at the time. There have been additional drivers I don't think anybody anticipated, and that led to a perfect storm earlier this year in terms of a shortage of supply and a significant increase in demand, and the pendulum has now swung the other way. But I dare say when we look at what is happening in the market today, we have some of the most resourced research houses who are changing their forecasts on a weekly basis, who do not all agree with each other's outlooks. This is not a time when you can use what's happening in the market today to make long-term fundamental predictions. Our positioning in the market, our relationship with our customers, our fundamental review of the markets and what drives the long term, we do not think has changed significantly, and that is what underpins our long-term thinking and strategic drivers. And look forward to Kleantha sharing with you what some of that fundamental analysis is. Thank you very much.
Thank you, Richard, and good morning and good afternoon to everyone. I'm Kleantha Pillay and I'm responsible for PGM sales and marketing. We are quite careful to distinguish short-term volatility from longer-term sustainability. Let's first address the short-term volatility in the market. Since early 2020, there have been a number of disruptions. On the supply side, we had the Anglo-ACP outage, as well as COVID-19 related shutdowns impacting on South African supply. Earlier this year, we also saw the flooding and concentrator incidents at Norilsk. During these periods of supply disruption, we had producers in the market as buyers, driving up prices. On the demand side, we saw COVID-19 impacting on auto, industrial, and jewelry demand. Supply chain constraints and the global chip shortage continue to impact auto production even today. And producers are flooding the market with spot metal, pushing prices even lower. We've also seen unprecedented number of changes to the vehicle forecast recently, which indicate to me a really high level of uncertainty, certainly around the short term. Short-term volatility requires very tactical responses. We've navigated this well with insights and intelligence from our strong customer relationships, and this has informed our short-term inventory planning and placement of metal into the market. Now, changing gears to the much longer term, we believe that the internal combustion engine does not disappear come 2035, and in fact will still make up the lion's share of the light vehicle car park. Announced bans by various cities and countries will impact just over a quarter of the 110 million light vehicles produced in 2035. But what does this mean for battery metal demand come 2035? Our long-term balances for these critical battery metals suggests that battery electric vehicle growth may well be tempered. By 2035, lithium demand will be 900+% higher than this year's levels, and current deficits will continue to deepen. Nickel demand grows from 250,000 tons this year to over 1 million tons by 2035, with nickel deficits forecast from the end of the decade. And cobalt demand grows fourfold from this year, with deficits forecast from 2026 onwards. In contrast to the short-term dynamics, our 10-year PGM market outlook is underpinned by solid fundamentals, which in turn informs strategic decision-making for the business. We understand primary and secondary supply very well, given our positions in these markets, and we also understand the auto market well, supported by our strong customer partnerships and insights. So let's dive into our 10-year forecast, starting with supply. Given the lack of investment in South Africa, primary platinum supply drops from 6 million ounces in 2019 to 5.7 million ounces by 2030, with just our K4 project and some very modest Platreef volumes coming to market in the second half of the decade. Although secondary supply is expected to see some modest growth of 200,000 ounces over the period, overall supply declines by a CAGR of 0.1% per year from 2019 over the decade. Moving on to palladium, we expect primary palladium supply to remain fairly flat from 2019 levels, with North American and Russian supply compensating for declining South African supply. Palladium recycling is expected to grow from 2.9 million ounces in 2019 to just over 4 million ounces by the end of the decade. Overall, supply grows at a CAGR of 1.4% per year, driven by growth in recycling. Recycling is expected to make up 40% of total supply by the end of the decade. The primary rhodium supply mirrors that of platinum, with primary supply declining 9% over the period. Growth in secondary supply results in recycling making up around 40% of total supply by the end of the decade. Recycling supply is impacted by a number of factors, but particularly by PGM prices and steel prices. Palladium and rhodium, both largely auto metals, are most sensitive to price, platinum less so currently. As substitution of palladium with platinum in gasoline autocats gains momentum, prices will shift, impacting incentives to return different metals to market. And because of this, we see some downside risk to our palladium and rhodium recycling forecasts. Now moving on to the other half of the market equation and looking at demand. Palladium and rhodium remain largely dependent on auto demand, which makes up close to 80% of demand. Historically, 20% of palladium was consumed in industrial uses, and this has reduced over the years as a result of deficits and higher prices. As demand for palladium in autocats is reduced through substitution, industrial demand could well return. 80% of platinum demand is split pretty much evenly between auto and industrial uses, with the rest used in jewelry. There have been a number of revisions to light vehicle forecasts since early 2020, just as the impacts of COVID-19 and supply chain constraints began to be felt around the world. In the space of just a short year, between Q3 2020 and Q3 2021, absolute light vehicle production forecasts have in fact increased, driven by upgrades to light commercial vehicles. However, looking at the chart on the right, in the same short one-year period, battery electric vehicle market share forecasts have increased significantly. Take 2027, for example. Battery electric vehicle market shares have increased from 9% up to 17%. Although during this period there were many political announcements around the banning of ICE vehicles and OEMs responding with aggressive electrification targets and investment targets, we haven't really seen any fundamental changes during this period to warrant such significant changes to battery electric forecasts. There is very little variance in absolute light vehicle forecasts over the decade, and this is in fact the key driver for auto demand. However, and as you can see in this chart, there is a significant divergence in forecasts for battery electric vehicle market shares from around 2023 onwards, with some forecasts as high as 40% by the end of the decade. Our forecast in the dotted turquoise line is not too dissimilar from others, and we're looking at 12% battery electric vehicles by 2025, up to 22% by 2030. Let's step back though and just put this into perspective. Last year, battery electric vehicle sales were 15% higher than they were in 2019, largely driven by incentives and subsidies in China and Europe. Going even further back, battery electric vehicle sales grew at a huge 82% CAGR between 2010 and 2020, but of course off a very small base. Our forecast implies a sustained annual growth rate of 26% every year for 10 years in order to hit these battery electric vehicle forecasts. This won't be easier to achieve, and therefore we actually see some downside risk for BEVs as well. Our light vehicle production forecast grows over the decade, and despite the growing battery electric vehicle market share, internal combustion engine production peaks at 88 million cars in 2027, much higher than even the 2019 levels of 85 million cars. Internal combustion engine vehicle production remains stable over the decade in the light vehicle segment. Heavy vehicle production is also forecast to grow over the decade, with ICE continuing to dominate the engine mix. 6.2 million combustion engine vehicles are produced in 2030, compared to just 5.8 in 2019. We are also quite bullish on fuel cell vehicles towards the end of the decade, forecasting a 7% market share by 2030. With longer driving ranges that heavy vehicles require and comparable refueling times to diesel vehicles, fuel cell engines are much more suitable in heavy-duty vehicles. Recent announcements on deployment of fuel cell buses and truck fleets, as well as hydrogen refueling infrastructure rollouts and further targets, particularly in China, Japan, South Korea, California, and the EU, have also been very encouraging. As hydrogen refueling infrastructure is deployed to support route-bound heavy fleets, light vehicles will also be able to take advantage of these infrastructure. So overall, the number of ICE vehicles remains robust throughout the decade, supporting PGM demand. Tightening emissions legislation in both heavy and light vehicle segments is also supportive of PGM loadings and hence demand over the decade. As you can see from these graphs, average loadings rise to meet regulation, followed by periods of thrifting to reduce costs while still meeting emission standards. It's expected that Euro 7 will be the last set of internal combustion engine emission standards around 2027. And it's also expected that the US and China will also follow suit. Moving on to substitution. Following a very successful project with the BASF to substitute palladium with platinum in gasoline autocats, uptake of the substituted autocat was faster than expected. And this was largely driven by the ability to self-certify catalysts in China. Substitution levels of 20 to 50% are being requested by OEMs. We're forecasting 1.5 million ounces of platinum added and palladium removed from auto demand by mid-decade. In the medium term, this creates a far more sustainable 2E demand that is far better aligned with the supply basket. Of course, having the pendulum swing too far is not ideal. Our project with BASF took 3 to 4 years from research and development to commercialization. The resulting trimetal catalyst has been approved and certified such that tweaks to the ratios of the 3 PGMs doesn't require recertification. So going forward, the timeframes to adjust catalyst composition are more likely to be in the 6 to 12 month range, which will allow for far more controlled substitution in the latter half of the decade as price incentives change. I also mentioned earlier that we're a lot more bullish on our fuel cell electric vehicle forecast in the heavy vehicle segment. And this drives platinum demand, moving up to just over 1 million ounces by the end of the decade. I think the most important thing to point out here is that auto and stationary fuel cells can be fueled by gray and blue hydrogen, as well as by hydrogen-containing fuels such as methanol. Fuel cell demand is therefore not necessarily coupled to green hydrogen and electrolyzer demand, and certainly not in the next decade while green hydrogen costs remain high. Demand for green hydrogen and hence PGMs in electrolyzers becomes relevant post-2030. Similar to our approach on battery metals, we're doing our homework to understand the entire green hydrogen value chain and identify opportunities for us. So overall, platinum demand increases as a result of substitution, as well as growth in fuel cell electric vehicles. We forecast declining platinum jewelry demand, while industrial demand grows at a steady 1% CAGR over the period. Palladium demand declines almost 2 million ounces over the period as a result of substitution, and as ICE vehicles begin to taper at the very back end of the decade. Tightening emissions legislation is supportive of rhodium demand through the period, despite thrifting in both the auto and industrial segments. Similar to palladium, demand tapers at the very back end of the decade as battery electric vehicle market share increases. So putting our supply and demand together, let's look at our market balances. Taking into account the ability to more closely control the rate of substitution in shorter time frames and our view of the downside risk to recycling, we present our base case as well as these two scenarios. Looking at the chart on the left, the grey columns show our base case with platinum moving into deficits through the decade. As substitution rates respond to changing PGM price incentives, we expect to see a more sustainable deficit for platinum from 2026 onwards, and you'll see we've modeled this in the turquoise columns. Similarly, we show both base case and controlled substitution for palladium balances on the right-hand side. And here you'll see palladium surpluses reducing as substitution is more controlled on the turquoise bars. We also show our scenario where palladium recycling forecasts are reduced by just a small 10% from mid-decade onwards, which results in a further reduction to the expected surpluses towards the end of the decade. Moving on and looking at our 2E balances, we forecast a sustainable market balance in our 2E base case. Taking into account the downside risk to palladium recycling results in a much tighter 2E market balance, with more modest deficits from 2025 to 2028 before moving into small surpluses post that. And then looking at the chart on the right, the rhodium market is forecast to remain in deficit from 2022 to 2029 in our base case. Our reduced recycling scenario, however, results in deeper deficits through the second half of the decade, with rhodium moving closer to balance by 2030. So putting all of this together and just summarizing what we've looked at, we understand supply extremely well given our position in the primary and secondary markets. Primary PGM supply declines over the decade, particularly for platinum and rhodium. However, supply is supported by forecast growth in recycling, but downside risk does remain. The internal combustion engine underpins auto demand throughout the decade. ICE vehicle forecasts remain well supported over the decade due to a growing car park, despite increases in market share for battery electric vehicles in the light vehicle segment. In the growing heavy vehicle segment, ICE continues to dominate the engine mix. And adoption of fuel cell engines in the heavy vehicle segment will accelerate in the second half of the decade, supporting platinum demand. Tightening emissions regulations supports PGM loadings over the decade. Over the medium term, out to mid-decade, substitution of palladium with platinum in gasoline vehicles helps balance the 2E basket. Overall, we forecast a sustainable 2E balance over the decade, with palladium moving into surplus and platinum moving into deficits in the second half. Rhodium remains in relatively small deficits through to 2029. Timeframes to change metal ratios in trimetal catalysts have reduced significantly, and this will allow for faster responses to catalyst formulations as metal price incentives change. Ultimately, this will result in an even more sustainable 2E balance over the second half of the decade. Modest reductions in palladium and rhodium recycling in the second half of the decade will reduce palladium surpluses even further, better balancing the 2E basket while moving rhodium into deeper deficits out to 2029. Our operations are ideally placed to deliver into this PGM market that we understand well. I'll now hand us over to James for questions.